Hey, Abtin. Welcome to the show. How are you doing today?
Hi, I'm good. It's a pleasure to be on. Finally moving from viewer to speaker.
Yeah, that's a good transition. I'm happy to have you here. We've been in touch through this podcast. We got connected a couple years ago. Thank you for being here. Can you please introduce yourself to our audience? What do you do? Who do you represent? And we'll go from there.
Yeah, my name's Abtin. I'm a director at Canada ICI Capital Corporation. At Canada ICI, we're a CMHC approved lender, and we also are a lender on conventional assets as well too, strictly commercial and 5+ units residential. And yeah, I would say about 70 to 80% of our business is CMHC, and the remaining of that is conventional business, whether that's conventional construction, term refinances on plazas, land, all other basically ICI investments, ICI asset classes.
So, you and I have been obviously working offline and we have a couple of projects. And I'm trying to make this episode as practical as possible. And the reason for this episode is because I do see a very interesting window of opportunity opening up in the next 12 to 24 months, probably, maybe even sooner, hopefully, in Toronto. And that has to do with these smaller mid-rise projects that are now step by step, day by day, they're becoming very slowly more viable. And I think at some point in the hopefully near future, we're going to hit that tipping point where these projects are going to start making real sense. And hopefully we will see way more of them on these streets. And I'm talking about the projects that have been enabled by the Major Street Initiative and EHAN Initiative in the City of Toronto, which for those of our listeners who are not familiar with it, basically says you could go all the way up to 6 stories and potentially 60 units on some of the on thousands of parcels in the city of Toronto, right? So what I'm want to kind of do with you in this episode is I want to kind of do a little bit of a role play, and I think it as much as we can, we want to make it practical. And the idea is I'm a new investor slash developer, and I have very limited experience in having done this type of project. And maybe I've done a custom house, maybe I've done multiplexes or something. But now I want to up my game, and I want to go and start doing these small mid-rise, let's call them apartment buildings, purpose-built rentals, and I really want to try and leverage and use CMHC Financing MLI Select program in particular. And I'm coming to you and trying to get your help and expertise to make one of these projects reality. Are you okay with that?
Let's do it.
Fantastic. Okay, so let's start with that premise. I'm looking at a parcel in City of Toronto. Let's say it's a 50 or 60-foot lot, and it's location on one of these. The location is on one of the major streets in the City of Toronto. I'm coming to you, and let me ask you this way: what are the first 5 things that you would ask me about the project before even deciding it's worth pursuing CMHC MLI Select or not?
Yeah, for sure. I mean, I would actually reduce the question count to four because I think there's four pillars to any successful CMHC deal or any even a financing deal to begin with. And then it's actually five pillars, but the fifth pillars is us as those who are presenting the deal. But the first one is net worth. Okay, what's our net worth position? Do we meet the CMHC requirement for net worth, which is 25%? And is that net worth in Canada, of course? The second pillar would be liquidity. Are we meeting the liquidity requirement needed for a project of this type? And then that basically the liquidity question, the rule of thumb has been 10%. It's kind of been the unspoken rule across the lending community with different credit groups. But again, that number could vary just depending on how much equity is in the project or how much equity needs to go into the project. But again, that 10% kind of buffer outside of the equity needed for the project has been quite consistent, especially in today's market where I could say, liquidity's kind of become the number one talking point when looking at a new project. So that would be pillar number two. Moving to pillar number three would be construction experience. So, you know, coming from a custom home background, let's just say it's your main line of business and you've built 20, 30 custom homes, we could see that transition from, a four going to a 4+1, that is feasible. And the build is comparable to what you've built in the past, but to go from custom homes all the way to a 6-story mid-rise, that's where it's a bit of a jump. So that's again one of the things that we're asking. What's your construction experience? Have you built anything similar to what you're planning on building? And then that kind of guarantees the direction we go in, where it's, hey, are you hiring now a builder, for example, who has the experience, who's built numerous 6-story buildings? Or if they don't have construction experience, then are you hiring someone who has the experience building these smaller multiplexes? And then the fourth pillar is property management experience. How are you going to manage this property once it's complete? Or using a third party? Will you be self-managing it? What's your experience and whatnot?
Okay, perfect. So that gives us a 10,000 feet view of the process. But now, if it's okay with you, let's start diving in. I want to kind of drill in and get some detailed answers from you, because as I'm sure you would agree, that the devil is in the details, and a lot of these things might look very good at the beginning, and
That's where
then
that's where the fifth pillar comes in, right? Where we present
what
and
is the
how
fifth
we.
pillar?
I would say the fifth pillar is how a deal is presented, right? It all depends. There's different stakeholders throughout the process: the CMHC, the lenders, the credit teams, and whatnot, that are sitting on different parts of the country, right? And it really
Mhm.
needs to be presented to them clearly in order for a deal to go forward. So I would say the fifth pillar, any successful deal, is how the deal is presented as well, too.
Okay. So I'm just going to do a quick recap here. So pillar one, net worth. Pillar two, liquidity. Pillar three, construction experience. Pillar four, property management. And pillar five is basically putting all of that together and making sure that it actually makes sense, making it a business case, if you may, right? Am I right? Like, I know way back when I used to briefly work in the investment industry, we used to build investment cases for new projects. Is that the same idea?
Yeah, very similar.
Gotcha. Okay, let's go. Is there anything, so sorry, before I start digging into this, is there anything about the actual site that you would look at and say, listen, like that one particular reason, for whatever reason, that one particular site or street or corner or area, don't touch it. CMHC just doesn't like you can't work it. Is there something like that can come to your mind?
Yeah, we haven't had anything, especially if we're speaking to Toronto. We haven't had anything of that nature where there's a specific corner or location where they just don't want to, the CMHC doesn't want to get involved. I would say you may run into something when you're looking at the tertiary markets or some of the secondary markets that have been slightly overbuilt over the past few years. And, there's just the vacancy rates are much higher. So they're going to underwrite a little bit more stringently on those. But again, we're in a bit of a housing crisis, specifically in Toronto. Affordability has been a concern, supply has been a concern. So up until now, we haven't really seen anything from our experience where they're saying, hey, we want to shy away from this in Toronto, unless, we are pushing the envelope on something such as rents, anything when it comes to the feasibility of the project. So I would say, yeah, point number 5 is deal presentation, but also making sure that we're looking at the location. Is it near transit? We're looking at the rents. Does this fall in line with CMHC's kind of
It makes sense.
goal, right?
Basically, what you're saying is that make sure it actually makes sense. You don't want to go and build units in a submarket that already has hundreds of units sitting on the market and not renting. That's basically what you're saying, right?
Correct. Yeah.
Gotcha. Okay. So let's move forward. And I want to kind of start digging into this topic of how much can I actually borrow? Because when you hear the head or read the headlines or hear the rumors on the street, you can get 95% of something, 90% of something funded by CMHC. Walk us through those numbers. What is the 95% actually referring to? How realistic is it? What is the actual things that you're seeing happening that prevents people from getting those numbers?
100%. I mean, 95% loan to cost or loan to value, those are the two you would say, or you're able to borrow up to 95% loan to cost. So sticking to construction on this one. Again, it's a metric, but again, CMHC and credit teams like ourselves are going to take a look at the underwriting, and we're going to make adjustments where we see best fit. And the same goes with the CMHC. So for example, one of the changes that we've seen the CMHC make in their underwriting is that, typically approved lenders were pulling their vacancy data from the CMHC portal that would show you exact vacancy rates for the specific zone, neighborhood, in some cases the census tract. And we'd look at, the most recent, the data is released in October. We'd look at the most recent October data, and then we'd also look at the trailing 4-year average. Whichever one was higher, that would typically be the vacancy rate that was applied to the application. However, there's strong data that CMHC has that shows, new built buildings after the year 2000 have a 5% vacancy, right? So an adjustment on your vacancy right there could drop you from the 95% down to 91, for example, right? Or 92 or 93. So is 95% a myth? Nope. Is every single project going to come in at 95%? No. So we've seen a ton of projects at 90%, 85%. We've even seen projects at 75%. It really just depends on how the underwriting looks, what the land cost was at the time when it was acquired, And yeah, again, which underwriting metrics get pushed and whatnot. And I think it's really with just going through the motions, right? I mean, if you think that your property taxes are going to be half of what everyone else's is, then you're already underwriting the wrong project or underwriting the incorrect way, and you're going to get a surprise when you get your certificate of insurance back to you.
And I guess at the end of the day, goes back to making sure that your numbers make sense. And if you're underwriting or writing a pro forma for one project, the evaluators and appraisers and lenders and analysts on the other side of the table are looking at hundreds of them. And it's really hard, not that hard to spot one project that has the numbers off the charts and not working. So be careful about that, please. And just to be clear, at 90%, 95%, or whatever the percentage you end up getting, that's loan to cost, including construction costs, soft costs, land costs, and or development charges if there's any, correct?
Correct.
So if I end up spending 10 million bucks on an entire project, I'll get 95% of that, not just construction or not just land value.
Correct. It's the full budget.
And I think one of the benefits that we know a lot of people are really interested in this program is because you also lock in your takeout financing at the time that this COI comes. And maybe walk us through that, elaborate a little bit on that, and why is that beneficial?
Yeah, I mean, the CMHC program's been ever changing. I mean, there's always changes coming out every few months. And when the program first came out in 2022, we had the scoring system where you could basically score 100 points via energy efficiency. And what that meant was someone could build a fully energy efficient building and get a 50-year amortization. Again, fast forward to June 19th, 2024, they made the change where now energy efficiency can only get 50 points. That's the maximum that you can get through energy efficiency. 50 points translates into a 40-year amortization. So the difference is with those who got their certificates of insurance between 2022 to June 19th, 2024, is that they locked in that 50-year amortization for once when they complete their construction. Those who submitted after June 19th, 2024 are now looking at a 40-year amortization. They could look for a 50-year amortization should they incorporate affordability. So now to be able to get a 50-year amortization under the MLI Select program, you do have to incorporate affordability into the project.
I think if I want to summarize my observation of the CMHC program for the past few years, it has been trying to push the applicants toward better projects, and by better I mean a mix of energy efficiency, affordability, and accessibility. So the better the product is, and the more in line that product is and the project is with those three criteria, the better terms you're getting. And it seems to me, and please by all means correct me if I'm wrong, but it seems to me that at one point maybe the requirements were not that stringent. The number of projects that were getting, the applications that were getting in and probably not getting funded were too many, and CMHC is trying to maybe reduce them to those to actually make sense. Is that correct observation, or am I?
Yeah, it's a good observation. We actually looked at the data in terms of how much purpose-built rental was being built around the country. So in 2010, the figures were about 20,000 units per year. Up until 2015, it stayed under 40,000. Since 2023, we've started at 81,000. Up until 2025, we're at 122,000. So that just tells you how much more, I guess you would say, business, or how much more insurance basically the CMHC is taking on. And they really want to fulfill their mandate, right? Which is to bring energy efficient housing, affordable housing, accessible housing to the market and bring
And
more of that.
this is their tool, and this is how they do it. This is how they push us toward it. And obviously, the change in the market conditions with the condos obviously pushes that trend even that much higher. Okay, so let's go back to the pillars that we were just talking about: net worth. And let's start with net worth. How do you, or how does a lender, or how does the CMHC look at net worth? What are the top 5 or 6, or I don't know, 10 items that someone would put in their net worth to meet that requirement?
Yeah, I'll just really go through a net worth form for someone, but I guess the Canada ICI template. And the first section we have is cash and savings. So how much money is in your checking account, savings account, any of the accounts that are related to the specific project, for example, the holdco or any of the other, or the LP account, for example. So we'll look at that. We'll also look at the marketable securities. Are there any stocks, GICs, or anything else that's owned? So those would be kind of put towards the liquid assets bucket. We would look at accounts receivables, accounts payables, any other loans that they may have outstanding as well too. This goes as far as car loans, credit card loans, line of credits, Then moving down, we would also look at business holdings and if there's any other investments on that end. And then moving down, we'd look at the real estate holdings. What assets do you own? What's the value today? Can that value be substantiated by a property tax statement, appraisal, APS, or an APS, and then subtract that from the mortgage amount at the time, and that's effectively your equity corresponding to how much your ownership is into that property. And then that basically gets us to our net worth figure, right? When we sum everything up and subtract all the liabilities. And then in terms of what really gets counted towards the net worth and what isn't, I mean, investments in private companies, the CMHC set that to zero on their end and they calculate what the net worth is. So if you've invested in a startup that's a private company, they'll set that investment to zero. So it doesn't count towards your net worth. Or if there's any precious metals or jewelry that you own, those are set to zero. So the watches, the Rolexes, the rings, set to zero. The same with vehicles and whatnot. So I would say the really important lines or the really important sections of a net worth statement would really be the cash and savings section and the marketable securities. So stocks, GICs, and whatnot. And then, of course, the real estate.
And I guess you kind of answered part of this question, but what are the surprises that you've seen people encounter when they're going through this exercise and come back and say, "Oh, I thought I was worth this much, but now apparently I'm worth half of it," or something like that? Is it because of the appraisals on land values, or like what else could be there?
Yeah, I mean, there's a lot of people who still think their property is worth what it was worth in 2021, 2022, right? Where in certain markets, you've seen values almost be cut in half. And this goes as far as some individuals' principal residences. And then when you get an appraisal done, or if you check the assessed values, which are typically lower than what the actual market value is. But again, you get an appraisal done, and you notice, oh man, 75% of the value that we previously looked at on land. It's been quite the drop in values, of course, as you may know, with where the development market's at, where the condo market's at. But those have been the big surprises. And to bring it onto the positive side, some clients are richer than they actually think when they actually dive into their statements, dive into the account summaries, and realize there's a GR stock portfolio that they totally forgot about and had great growth, especially with kind of this
That's a
bull
very
run
good
we've had
problem to have.
recently.
Yeah,
Yeah.
that's a very good problem to have, to find maybe a lottery ticket in your pants that you forgot about. That would be also even better. Okay, so with that, let's switch gears. We go forward. We touched briefly on the question of experience. That was the other pillar in the discussion. We've talked about net worth. I'm going to circle back to liquidity later, but I want to kind of dive into the experience part of it. And quite frankly, because there are not that many people and not that many developers, especially on the smaller side, who have worked on these scales of projects. What is your take on that? Are you seeing first of all, have you seen any of these applications go through yet? How do you anticipate CMHC or the London community would generally approach this?
Yeah, I would say, we started financing Canada, I say as a whole, our business has always revolved around some of the larger stuff, the mid-rise buildings, the high-rise buildings, and the larger subdivision style projects. In 2023, our team financed its first multiplex. It was a project out in the Ossington area. It was a 4+1. This was the time when you would have to basically get the permit for the 4 units, then close the permit, then get the permit for the garden suite. So what we were doing on those files were CMHC takeouts because they were coming to us with a completed building. These were custom home builders that were coming and doing this. So right there, you're showing the CMHC on a CMHC takeout that, hey, you've already executed on a 4+1. Now, when you go back to them, I guess fast forward to, I think it was June 2025, where they started, the city started to offer all permits up front. Fast forward, when you're able to do so, to go through the CMHC with help, you're able to get financing through the CMHC for these multiplexes. They're more than happy to do that business. So that's one of the angles that we've had success. But a lot of the groups stepping into the space now, going into their first multiplex project through the CMHC, we've been able to do that for them. But again, it's really substantiating and making sure that it's evident that these groups have the experience to take on such a thing based on their track record with residential homes. We'll look at their Terry-on history, for example, just when we're doing our credit meetings. We'll look at what they have on the HCRA, see how many completions are registered there. Those are all things that form a part of the resume, form a part of the story, and that relates back to pillar number 5. So it's like, okay, great, you've built 30 homes, but if you've also had 30 claims on Ontario, that kind of says something to what you're building, right? And the same goes it's a concern for credit teams because we're not coming in finance. We're usually financing the construction because we're planning on financing the term piece as well too. So we're not looking to have issues 2, 3, 4, 5 years down the line into our term loan.
Yeah, you don't want to have
Where
long-term issues with the actual asset.
correct, with leaks, anything, right? It's a drain on the borrowers.
So when I go to the larger one, like a mid-rise project, and I guess the part of the answer is to bring in parties who have proven track record of doing that. What does that bring in mean in terms of how, what do you need to do? Do they need to come in as a partner? Do they need to come in as a, I don't know, CCDC 5A contract? Like how does one satisfy CMHC with the lending that, yes, okay, I didn't have the proper experience in house, but somehow I've checked that box.
Yeah, I would say for the mid-rise projects, I would say definitely being well above that 25% net worth requirement, above that liquidity threshold is key, because it's almost an investor and builder relationship now. So they really want to make sure that that individual is well insulated, and then also bringing in a very strong group, so there's no, there's no cost overruns, right? Project remains on schedule, on time, because again, there's an interest reserve for these projects. They don't want it to go outside of schedule or anything where now you got to cut up interest out of your pocket. And that whole idea of bringing someone in, it could be in the form of an equity partner. It's always great. Or it could be in the form of, signing a CCDC 5B. For example, some of the groups, or 5A, of course, depending on which institution you're working with. And some other institutions, some of the Schedule A's that we've worked with on some of these mid-rise buildings actually want the CCDC 2 in place, so a fixed price contract with that group. And it's just all about kind of taking the risk off. With a CCDC2, of course, it's a fixed price contract, right? And then CMHC's new rule recently came on 25 units plus, where the wording is most likely, but they're going to apply a bonding requirement there, right? So really ensuring that either that GC who's bringing on the project is able to get bonded, or the trades that are being used do have some sort of bonding capacity.
Okay, so if I'm doing the first time, if it's my first time doing this, it's probably best that I don't go over the 25, because that also obviously is a bigger scale project. Typically, I will need more than one lot to make that happen, and it's also higher liquidity and net worth requirement coming in, and also the bonding. The bonding is easier said than done. Having been through the whole bonding process, it's not impossible. It's definitely doable, but making the pro forma work with bondable trades on smaller jobs, it's a feat of its own for anyone who hasn't been through it. Okay, so we've covered net worth, we've covered liquidity. Let's talk about property management, because I think that's one of the things that maybe it's not talked enough about. What are some of the high level things that someone should consider when thinking about that pillar?
Yeah, I mean, it's really about experience managing properties, managing residential properties, managing the whole process with landlord tenant board. That's the kind of what I would say, whether you're an investor into these projects, or if you're looking to take one of these on, is really like, hey, do I possess enough experience managing properties? Have I been managing a portfolio, for example, of multi-units, whether that be triplex, quadplexes, or whatever it be, across the GTA? Have I been managing this for 5, 10 years, for example? And do I have systems in place now to manage a building with 20 units in it, with 20 tenants in there? Or should I look to really bring on a group and sign a property management agreement prior to construction starting for this building, right? And again, a landlord-tenant relationship is always both ways. I'm not going to go too deep into it, but the wrong property manager could make tenant experience horrible, and that could drive rents downwards, and that drives the property's performance downwards. And next thing you know, the property's in default, right? And that always goes with, tenant screening and all those things as well too, because you build a 20-unit building, you bring in a bunch of tenants that, may cause issues or whatnot. It could ruin the experience for other tenants. And again, those are all things that come into play. So the CMHC could actually mandate having third-party property management in place. So you may think that you have the experience, but again, if the CMHC doesn't really buy it, they could mandate the third-party property management within the certificate of insurance, and then prior to the construction loan being advanced, they would require to see that signed property management agreement with the third party, and they would look at
And
their resume, of course, too.
I'm beginning to think that it might be treated the same way that Terion used to treat condos, because Terion, and basically when we wanted to start condos before, you had to have a property management team, which was a reputable company, actually prepare your first year budget before you even were able to start selling the units, because they wanted to have a decent estimate of the cost of running this building, the maintenance fees, and whole bunch of other details. So that was a very defined and well organized part of that process, which sounds like we might see an equal version of that over here as well. Is that correct?
Yeah, again, when anything gets popular, I mean, right now, the CMHC, we've heard about this data that they're responsible for about 85% of rental construction starts across the board.
Mhm.
The process needs to they have to implement these things in order for it to be efficient and also to bring their overall risk downwards, right? So I would say it's the same way, and really just making sure that all parts of this puzzle, which is multifamily development and also multifamily ownership, are solved for. And that really brings down their risk level. And then again, for that 15% slug that's not using CMHC, they're usually going to translate to coming back to the CMHC via CMHC
That totally
completion
makes sense.
takeouts and
Yeah,
whatnot.
they will do traditional financing just to build the construction and build the building and do the construction financing and then eventually do a takeout. Yeah, why wouldn't you do that? Can we briefly touch on the LPGP structure and how that potentially affects these deals? Because the way I'm seeing this and the way I'm envisioning what probably will happen in Toronto in the next few years is that we'll probably see a number of LPGP setups, and that's general partners and limited partners. And maybe someone has a piece of land and he needs to partner, or he or she need to partner up, or they want to partner up together and purchase a new property. Is there any red flag that are there any different requirements when an LPGP structure is put in front of you versus a simple company that owns a property?
Yeah, I mean we've seen all the structures, LPGP, just a sole owner owning the property and whatnot, especially given that, previously we used to be financing. I mean, still are financing, of course, but previously the majority of our business was all larger loans. So LPGP was something that's very common, and has been common. So whether there's a benefit or whatnot, it's more so I would say to the ownership for them. The CMHC knows how to process them. Credit teams know how to process them as well too. And again, there's not. It's really just they'll look at who the guarantors are, and we're still going to have to check the box of 25% net worth and 10% liquidity. But again, there's no really. I can't really say that there's any benefit to doing so when it comes to financing with the CMHC. It's just another organizational structure that we've seen, and it's kind of been something that we've been handling kind of since the beginning of our business.
Sure. We touched on bonding as another item. Can we quickly go through timing? What is an overall process? And I would appreciate it if you could talk about different scales of projects. Like, so if you're doing a fourplex, maybe is it different than doing a sixplex, or is it doing potentially different than doing a mid-rise 20, 30 unit project? Are these are the timelines any different? At what point in time is it better for people to contact someone like you, start the process? And yeah, maybe just walk us through the timelines and durations, please.
For sure. Yeah, we always like to get involved as early as possible, even at the land acquisition stage for a development that may break ground in 12 months. We always like to get involved early, just underwrite the project, make sure it makes sense. Because again, there's a multitude of things that could happen. Certain things may be offered. For example, one of them is reduced property taxes that some of the municipalities offer for projects, and you underwrite the project, and you underwrite with the reduced property taxes, and you're like, wow, I'm getting to 90% loan to cost. This is great, but we actually need to underwrite based on what the property taxes would actually be should there not be those reduced property taxes for a period of 10 years. So those are just some of the things that we like to get involved as early as possible. So timelines, again, the larger the project, of course, there's different queues at the CMHC with different levels of underwriting or different levels of, you would say, underwriters that need to pick up a file. From our experience, the files that are 90 million plus, those typically take the longest. Again, there's only a handful of underwriters at the CMHC that could handle those transactions, and it takes a bit longer for them to get picked up, of course, just because depending on the time and how much volume is getting pushed into the CMHC, especially after a major change is announced, we'll typically notice longer than usual wait times in the queue to get those files picked up. For some of the smaller ones, I would say the 4+ ones, the 6+ ones, those have been pretty quick, but again, they are construction files, so they wouldn't be as quick as your CMHC construction takeout files that get picked up, right?
When you say quick, can you give us an idea? Like, are we talking weeks, months? What are we talking about?
Yeah, right now we're looking at about 3 to 6 weeks for some of the smaller stuff, and then for when you go to the larger projects, you're looking at anywhere from 6 to 12 weeks, I would say, depending on just the capacity of the underwriters.
Gotcha. Okay,
And that's just the
that's
CMHC queue, right? You always have the
Mhm.
lead time before. So the lead time to prepare a package, go through credit, that could take anywhere from days to weeks, just depending on which institution you're working with. And then after the file is picked up, the underwriting process could take anywhere from a week all the way to a month. Just depends how many questions and come back. And then after the certificate of insurance, funding could take anywhere, just depending on the complexity of file, number of groups that are involved. Again, you mentioned LPGP, right? If there's a bunch of entities, that's going to take much longer for the lawyers and the lender, of course. But again, funding could take anywhere from 4 to 6 weeks, and I've seen it stretch out to numerous months as well too.
was just going to say, I have seen there are projects that even though they have CMHC financing and even though the CMHC financing will come through at some point, the owners and developers end up paying the first 1 or 2 months or maybe even more of the construction costs from other resources, from other sources before the actual funding lands in their account. How often and how common do you see that happen?
Yeah, I can't really say I've heard of a project or worked on a project where, someone underwrote their equity contribution to be 500,000 on a $10 million project, and that's exactly the amount that they ended up putting in, and the funding kicked in, right? It's
Right.
always You're always over contributing your equity, of course. I mean, the way that the CMHC draws are even processed is that they pay you, it's on a cost to complete basis, right? So you really have to complete the work, and then the funds are dispersed for that work that's completed. So they're not going to fund you to do work. They're going to fund you for work that's completed. So you're always going to be in a cycle of front loading equity and then getting your draw a month or two after.
So for all of our listeners listening to this, because I've heard this conversation unfortunately multiple times before, yes, you will get 95%, but you will get it after the fact. Most of the times you like Optin was mentioning, you have to spend the money, get the work done, and then you will get compensated for it. Okay, let me try and start wrapping this up. Before we do that, can you give us some idea about the actual numbers that you're seeing? Like the rates, the premiums, and also maybe some of the benchmarks that you and the community and even CMHC is using to come up with these valuations, like in terms of rents, what are the sources? If I'm an investor, if I'm looking at a project right now, where can I go to see here's the benchmark that CMHC or the lending community is going to gauge my rents or the construction costs? Or can you walk us through, maybe give us some references if available to check those numbers and give us some guidance?
100%. I would always say when it comes to rents, you use the resources such as rentals.com, PadMapper, realtor.ca to really check what similar type product is leasing for in the immediate area that you're going to be pushing forward with development. I would say
Okay.
don't skip out on the building that's right next door to you. Look at the rents that they're getting at the building right next door, and don't look at the building that's 4 or 5 kilometers west or east or north or south of you, right? That's getting the rents that you're looking at, right? And of course, you got to look at it with reference to what quality of finishes you're going to be putting in, what amenities you're going to be putting into these buildings, and what quality. Again, are you going to be offering parking? Are you not offering parking? Those are all things that I think need to be considered. Again, the CMHC has their own kind of real estate appraisal team that conducts kind of analysis for them if need be for files. And then again, the approved lenders as well too. We have our own data when it comes to a lot of projects. So there may be a project across the street from your project that you're submitting for, and we see what their appraisal came in at, and we're seeing what kind of rents they're projecting that the property is going to be attaining when it's completed. So it's kind of, again, coming back to pillar number 5, putting it all together. But those are some of the resources I would say to use. In terms of vacancy rates and whatnot, we spoke to that a bit earlier, but the CMHC portal is a great tool. You could really just scroll into where exactly you are on the map, and it'll tell you what the vacancy is for there. Depending on the area, the data could get very, very detailed, all going down all the way to the census tract. But again, I still would underwrite to a minimum of a 5% vacancy on projects, depending on which area you're in. And 5% just for Toronto right now. If I'm underwriting in other pockets or tertiary markets, secondary markets, that can go upwards of 10% on the vacancy. In terms of expense benchmarks, there's data on mill rates and whatnot that I would use. I would also speak to your appraiser on expenses and overall the whole pro forma, but those are just some of the resources I would recommend to someone to use.
And obviously, we're going to put a disclaimer here again for everyone listening that please don't make any decisions based on the data and the numbers that we're presenting in this episode. This is just for educational purposes only, and you should talk to your qualified people, legal assist, legal accounting, and likewise before making any financial decisions. With that being said, can you share any rates or actual interest rates, premiums, and stuff like that from the market today, and how they have changed maybe in the past, recent past, or if you're anticipating any changes to come up?
Yeah, I mean, rates. I think this is a. I wish there was a disclaimer button that I could press, but bond yields have shifted quite significantly. So the rates that we quote today compared to when this podcast is released may change significantly, may go upwards or downwards. So I just want to give that disclaimer. But again, for some of our larger product, again, it's a spread over the CMB when it comes to the fixed term rates. And for the larger product, of course, the spreads are lower. The smaller the project gets, the spreads go wider. So we're seeing rates anywhere from 3.5% to 4%, and then for the really small ones, you're going above 4%, I would say. But again, it's the cheapest interest rates you could actually receive in Canada at this time, right? So it's all following the
It's
bond
pretty
yields, and
good.
if the bond yields jump, then so will your rates, because you could be quoted a spread over the bonds. But if the bond goes up from, let's just say, 3% to 3.2, well, now your interest rate is 0.2% higher, and it's really fluctuating up until the day that you rate lock.
Sure. Okay. Thank you very much, Upton. This has been very informative. Is there anything that I haven't asked you that you wish to flag to our audience before we wrap up?
Yeah, I would just I would say, I think you touched on it earlier, just any project you're looking at, really look at the feasibility of getting it into the CMHC as early as possible. Really lock in that certificate of insurance, lock in what your exit would look like after you're done building by going into CMHC construction, and always speak to your approved lenders if that is an option, if that is a possibility for you. I would say the majority of our relationships started on the completion takeout side and then translated to us doing a lot of construction business for them through the CMHC. So I think that's one thing I would leave the audiences with. The programs ever changing, and we really want to, if you want to really be on the safe side, it's really good to get your projects in as soon as possible and lock in your certificates and lock in your exit.
Perfect. Where's the best place for people to find you?
You can find me on LinkedIn, and then my first name, last name on Instagram. We like to highlight some of our highlight deals, or some of our deals that we like to talk about there too. And then always able to be reached via email, phone, whatever it is.
Perfect. Thank you very much, Upton. We'll put additional information in the show notes. And thank you for being here.
Thank you, Pam. Always a pleasure.